Welcome back to Cashflow Confidence Live, where accountants learn to become fearless cash flow and profit advisors. I'm David Safier, here to help you close the clarity gap and grow your advisory impact. Let's dive in. Picture this. You're working with a client whose business is bleeding cash or has some other problem, and you know exactly what is wrong. And you start explaining the situation, and you watch as their eyes glaze over. They're not stupid. You're not bad at your job. But here's what's happened. Accounting concepts slipped into what should have been a really simple conversation. Today, we are covering cash flow advisory principle number 2. Use common sense and plain language. And here's the core truth that will transform how you serve your clients. Cash flow is easy. Cash flow is obvious. And cash flow can be explained using simple math. If your explanation gets confusing, you've let accounting hijack the conversation. This is a critical principle because your clients can get drowned in the complexity of accounting. They need you to be a translator. Think about how long it took you to learn accounting, and that your clients, for the most part, won't be expert accountants. You need to be the translator from accounting to plain language to make cash flow crystal clear. Stick around at the end of the show. I'll get you free access to cash flow advisory resources to help you build confidence in cash flow and profit advisory practice. But first, let's hear from our sponsor. Our sponsor is Pivot 2026. It's a 4-day in-person cash flow bootcamp to master the cash is clear process. If you want to master cash flow advisory in an immersive environment, join us at Pivot, the Unconventional Cash Flow Conference. Let's dig into it now. Let's talk about the fundamental problem that communication between you and your clients. Let me start with something that might make you uncomfortable. Everything you were trained to do as a financial professional works against you when you're doing cash flow advisory. And here's why. Your accounting and CPA exams, finance exams, your accounting degree, your professional development, all trained you to think about accounting language, accrual basis, matching principle, revenue recognition, GAAP compliance. You get it. There's all this jargon, and it's really valuable. You need it. It is absolutely essential for tax returns, audited financials, and regulatory compliance. Here's the problem. Accounting language actively obscures cash reality. Think about your typical client. Maybe they're doing $5 million in revenue. They don't care about accrual basis adjustments. They care about one question. Will I have enough money in the bank to do what I want to do with the company? And that question doesn't require understanding depreciation schedules or revenue recognition. It requires simple addition and subtraction. But because we're trained in accounting, our brains automatically reach for accounting concepts to explain cash problems. And this is where we lose our clients. And I've been there. I had to deprogram my brain as I went and tried to work with clients. And they looked at me and said, I have no idea of what you're talking about. Let's do a plain language test. And it is, here's the simple test. Could I explain this to a smart 12-year-old? 12-year-old, junior high school. Okay, even go to high school level. And if not, I'm probably using accounting language when I should be using cash language. Here's an example. Here's my accounting version. You ready for this? You'll probably understand every word. Your net income is positive because we're recognizing revenue on an accrual basis, but your negative operating cash flow indicates a working capital constraint related to your accounts receivable timing and inventory turnover inefficiency. I don't know how many phrases are in there. Yeah, I'm reading it because I couldn't memorize it. I don't talk like this anymore. There's probably 10 accounting principles there. Let's do the translation. You made sales this month, but your customers haven't paid you yet. Plus, you bought inventory with cash. So even though you're profitable on paper, you don't have money in the bank right now. And then, of course, you can throw in the numbers and show them exactly what those numbers are. That's easy to understand. That's plain and simple language. Both statements describe the exact same situation, but one of them helps your client understand what to do next. The other one confuses them. Here's what this means for you as an advisor. Your job is not to demonstrate how much accounting you know or how much you learned in school. Your job is to translate complexity into clarity. Any accountant can generate a complicated report. Only the skilled advisors can take that complexity and make it actionable through plain language. And that's your competitive advantage. Let me give you a framework that replaces complex accounting analysis with common sense. Every cash flow conversation should answer some simple questions. There's 4 of them. Watch how straightforward these are. Question number 1, how much cash is coming in? Not revenue, not sales, and not, recognized income from an accounting perspective, cash that actually hits your bank account or is projected to go into the bank account this week, this month, this quarter, to be able to do a cash flow projection. This is simple addition. You add the first deposit and the second deposit and the third deposit until it equals the total amount of cash in. Most bank statements actually say total cash in if you're looking at the past, and that's what you're trying to project is total cash in. A business owner can look at that same bank statement and say, oh, look, they match if it's a past number. This is the beginning of a simple cash flow model that predicts and understands the future. No accounting required. Okay, so here's question number 2. How much cash went out? Well, it's just the opposite. It's not your expenses, which are theoretical, or cost of goods sold, which could have been paid for in cash a year ago, and they're not accrued liabilities or a depreciation. It shows up as an expense. We're not talking about that. How much cash actually left the bank account? That's the question. And don't forget, I just mentioned some invisible expenses that show up on your P&L, but they will show up in your bank account. But there's also some other things that won't show up in your bank account that do show up on the P&L. All that's got to get washed away, the differences, and we just need to focus in on cash. Again, simple addition. Expenses, add them up, and there's the total expenses, whether it's past or future. Your client can see them all when it's a true cash expense, not the theory, but it's what actually happened or what is going to happen. Question number 3, what's the difference between the two? Did more cash come in or go out? This is 3rd, 4th, 5th grade math, depending on how big the numbers are, but it's just subtraction. Cash in minus cash out. If it's a positive number, great. You had positive cash flow. Negative number, negative cash flow. Are we going to have a problem? I'm oversimplifying. Hopefully you're not bored. Let's move on to question number 4. Question 4. Can you pay your bills this quarter? Not today, not this week, not this month, but you need to project out a quarter because that's how long it takes to react if there's a challenge. So you use a simple or complex, hopefully it's simple, 13-week cash flow model. Do you see any negatives at the end of a week? Yes or no? Will they have the cash they need each week? And that's the question that keeps business owners up at night. Will there be cash in the bank when I need it? And it has a simple, calculatable answer. So you notice something about these questions. None of them require understanding anything about accounting, not depreciation, not amortization, revenue recognition. They require basic arithmetic and common sense. This is the language that your clients already speak. When you use it, you eliminate the clarity gap instantly. Now, there's 5 danger zones that I see constantly where accounting creeps in that it's taken me more and more effort to eliminate this language than the other areas of accounting. I'm going to give them to you right now. Actually, there's only 4. There's 4 places. Number 1 is revenue recognition. Accounting wants to match periods and say, okay, this is when it was sold and when it was earned, and that makes sense for financial reporting. But the moment you start explaining accrual revenue recognition to a business owner, you've lost the cash flow plot. And here's the plain language version. I've noticed you invoice the customer in March for $50,000, but they're not paying you until May. So March cash flow doesn't include the $50,000. May's projection does. No accounting jargon, just the simple truth about when money hits the bank account. So here's number 2, that's a difficult one to get rid of. Depreciation and amortization. They are purely accounting concepts. They spread the cost over a period of time for tax and reporting purposes. And it makes sense for large companies. I'm not trying to say don't use it. What I'm trying to say is the critical point. Depreciation never took money out of anybody's bank account. It just doesn't happen. So instead of saying the depreciation, let's look at the plain language version. You spent $50,000 in cash last year when you bought that equipment. The money's already gone from the bank account. This depreciation of $10,000 expense on the P&L is just an accounting calculation. It doesn't affect your cash flow now. So that's explaining the past. The harder one is, hey, look, there's only $10,000 taken out, and we spent $50,000 on that piece of equipment this year. What are you doing? They think that you're crazy. And the easy way to say it is, yes, we took that $50,000 into account on our cash flow because, yes, you took $50,000 out of your bank account and you paid for it. However, from an accounting perspective or from a tax perspective, we're only allowed to show $10,000. So that way, sorry, that's just the way it is. That's why we do cash flow instead of just accounting. We need to do both because cash flow will help you know what you can do because it shows you how much money you have and you will have. Your client will understand this. Danger zone number 3, accounts receivable aging. This is one, yes, it's good that clients have an understanding of what accounts receivable is and that they get older. But aging reports are used for collections and they're sort of bad for cash flow conversations. And they use accounting terminology, but that's number 1. Number 2, they're only theoretical. How many clients actually pay on the date that it's due? They're generally early or late, even if it's a day early, a day late, or a week early, a week late, even if it's not a big change. So the plain language would be, these 15 customers owe you $73,000 in total. If they all pay within their terms, then the cash hits your account in 30 days. If they don't, you'll need to cover expenses. But what we are going to do is look at your 5 biggest and see when they really pay historically. And if they're late, we're going to have to project late revenue. And if historically they've paid early, we'll be able to bring it in. So now your client knows exactly what to do. Oh, and you could add on there, and let's call those 5 biggest customers and verify they have their invoices and make sure they're going to pay. Try to do the best you can to make sure they're going to pay on time or early, regardless of what their past performance was. That's actionable information. It's not day sales outstanding or AR turnover ratios. That's where it starts to get confusing. Next one, inventory valuation. Danger zone 4, inventory valuation. FIFO, LIFO, weighted average costs. Those are all accounting methodologies that have nothing to do with cash flow reality. Here's the plain language version. You spent $42,000 in cash to buy this inventory, and then when you sell it, you'll collect $67,000 for customers. The difference of $25,000 is your margin. That's the cash profit waiting to be realized in your inventory. Your client understands buying price, selling price, margin. These are basic business issues, not really accounting. You can do it with cash, right? You take dollars or euros or whatever pesos you use. It's easy. It's understandable. Inventory valuation confuses everything. And certainly the fact that you're taking cash and taking it out of the bank and putting it into inventory and it shows up as zero expense on your P&L, really confusing. That's a fun one to explain to clients. So let's do a little bit of translating. I'm going to talk to you about a system to translate. It's 5 steps. I'll make it fast. Number 1, start with the bank account. Let's look what's happening in your bank account. That's grounds the conversation in reality, not accounting theory, actual money. Use cash verbs. Received, spent, deposited, paid, transferred. This is what not to use. Do not use accrued, recognized, allocated, amortized, capitalized when you're trying to talk about cash. The cash verbs describe the money movements. Accounting verbs describe theoretical treatments of money. Step 3, use actual dollar amounts or whatever currency you are using with your client. Not percentages, not ratios, not indexes. You say $47,000 came in last month, $52,000 went out. We have $5,000 negative cash flow. Don't say your cash conversion efficiency declined 8.7% quarter over quarter. Your numbers, the numbers that your client need can be seen in their bank account, and they're real, and statistical measures are completely abstract. It's another layer of confusion. Step 4, state the obvious. You are spending more money than you took in, so your balance went down. Don't try to soften the truth with complex language. Business owners will respect direct communication. It's one of the most frequent questions I get in my masterminds. David, how do you tell a client that they're not doing well or they're doing something wrong? And my answer is I use plain language to explain the ramification of their actions, and I'm honest. And you have no idea, if you haven't tried honesty, let me suggest it. I get appreciation because nobody's told them this before. Doesn't matter how many advisors they've had. State the obvious. Step 5, for complete translations, connect to decisions. This So when you're talking, this could be a quote. Ready? This means you need to either increase deposits or reduce payments next month to avoid running out of cash. Simple language. I often say, bring more money in faster. Let's go collect money, or slow down expenses. Every cash flow explanation should lead to clear action. That's what advisory is clear action. Let me show you how this works with a real scenario. We're going to do the accounting version first and then plain language. Q1 net income was $45,000 on an accrual basis. However, your statement of cash flow shows negative $23,000 from operations, primarily driven by working capital adjustments, including a $38,000 increase in AR and $15,000 inventory build, offset by a $22,000 AP increase. Wow. Yeah, you've got to go through accounting 101 to understand all that. And even then, you need some practice. So here's the plain language version. You made $45,000 this quarter, according to the bookkeeping, but your bank account actually went down by $23,000. And here's why. Your customers owe you $38,000 that they haven't paid yet. You spent $15,000 in cash on inventory, and your vendors, well, this helped, gave you $22,000 worth of payments. We got some extra time for that, so that helped. But the bottom line is you need your customers to pay faster or you'll run out of cash, even though you're profitable on paper. Both versions explain the same situation, but only the second one leads to action. So why does this build a relationship? Complex language doesn't make you look smarter. Simple language gives your clients more confidence in your advice. When you explain cash flow in plain language, customers understand their situation clearly. They make better decisions immediately. They trust you more because you've eliminated confusion for them. And they see you as a translator who makes the complex simple. They can actually implement your recommendations. When you are using accounting jargon, on the other hand, clients feel confused and even stupid sometimes. And they'll tune out because they can't follow you and they can't explain this to their team of the people who have to help them implement. And they're much less likely to take action. And they will actually start wondering if you understand their business. Think about it from a client's perspective. They have hired you to help them understand and control their cash flow. If you're making it more confusing, you're failing the key mission. I keep thinking about doctors or lawyers or mechanics or somebody else who has specialized knowledge. And you can think of your own situation. Think about the last time you went somewhere and they either talked to you like you had studied law for 3 years, using all sorts of complex terms without saying this is what the ramifications are, or a doctor who tells you all sorts of complicated medical stuff really quickly and expects you to understand it all, or a mechanic who's trying to tell you what the heck's going on. And quite frankly, for me with the mechanics, is just like, just tell me how much it's going to cost. Has that happened to you? If it has, that's exactly what you're trying to avoid with your clients. Your job is not to show how much accounting you know. You need to know the accounting so you can do the work in the background. Your job is to help your clients understand and control their cash flow and using the simplest possible language. And it's not dumbing down. It is actually more precise communication. It's taking the accounting concepts and translating them into the only language that matters for cash flow decisions and for your clients. What actually happened to the money that really happened in the bank accounts, and what's going to happen to the money that's really going to happen in the bank accounts. And here's the business truth. Clients who clearly understand their cash flow, they will become long-term advisory clients. They will see value immediately, and they'll implement the recommendations, and they will refer other business owners to you. And here's the best part. I'm generally talking right now about managing cash flow. But when you start getting into maximizing cash flow, because you've identified problems and you can explain those problems in plain English and demonstrate the savings that will happen and the benefit that will come to the company, it will add up to 10, 20, 30% of the revenue of that company. And I'm not exaggerating. We'll have some other videos on that topic of how do you show value and how do you tie it into cash flow and freeing up cash. So that's coming down the road. When you do this, use plain language and build that type of relationship, you could become the long-term advisor that they will happily pay $1,000, $2,000, $3,000 a month because it's no longer a cost. You become an investment with a return that they receive for their company. You do it through clarity, not through complexity. Here are 3 specifics that you can do this week. Number 1, do a translation exercise. Pull up the notes if you have them from the last 3 conversations with clients where you're discussing cash flow issues or some other problem. And if you don't have notes, just think about it in your mind and find one explanation when you used accounting language and just try to restate it in plain language. And you can go back and use that 5-step translation protocol. Practice using plain language version until it feels natural. It probably won't when you first try it. You'll probably trip over yourself. How do I know this? Because the people in my mastermind, we do exercises like this, and it happens to them. It's okay. Just get up and try it again if you trip. Number 2, that whole 12-year-old test. Before your next client conversation, ask yourself, all right, I'm going to talk to them, and you're prepping to talk to them about something. How would I explain this to a 12-year-old? And if you can't do it, take a step back and work on it. And if you need to, talk to somebody else who doesn't understand accounting and say, here, I've got to explain this. Do you understand it? And if they say no, say, help me figure out how to explain this to my client. You don't have to give client details away, but work with somebody who is uneducated in accounting. That's the best way to practice. Or just practice on your clients. All right. Next thing, jargon awareness. You could make a journal that every time you're talking to a client, or it could be anybody, and you start using accounting terms, and it's hard to do because you're so close to the situation, you forget this is a term I learned in first semester, second semester accounting. It is natural. Everybody understands this because that's just, we breathe this language. Make a journal or just write it down, do a little check, and you'll start seeing how often you use jargon. And maybe you don't have a problem, but if you do, you'll get an idea of the size of it. If you want to learn this system, if you want to learn how to translate complexity and how to master plain language and master cash flow advisory, well, you can, and you can turn it into a thriving advisory practice. Check out the Cash is Clear Advisory Program. You can learn all about it at www.cashesclear.com. It's 5 steps: mindset, model, manage, mentor, and maximize. What we've been talking today fits into mentoring because this is talking. You have to teach. It could also fits into it fits into mindset, which is your mind and your mindset, but it's also the client's mindset. We've got to get those to match. Model, and manage. Those are we've actually been talking about 4 of the key steps. And I mentioned maximize, which is the fun one. Those are all keys to building high value advisory relationships, because those are the keys to cash flow mastery. Again, a quick note: if you want to master cash flow advisory in an immersive environment in 4 days, join us at Pivot. It's 4 days at an all-inclusive luxury resort where we will compress 16 plus weeks of hour-long masterminds into training that's a transformation. You will leave boot camp with a great experience understanding every step of the process. You'll learn the complete framework, and you'll also build relationships with other financial professionals and with me and my team, and leave with everything you know to launch or scale your advisory practice. See the details at Pivot, Pivot, 2026.com. Hey, thank you for turning into Cashflow Confidence Live. I hope you found today's episode valuable and that you are inspired to take the next steps and to take these new advisory skills to the next level. If you haven't already, please subscribe to this show. Please subscribe to my channel if you're on YouTube, or if you're on Facebook, follow me on my page there, or on LinkedIn. Follow me, follow our company, and look for more announcements. It's every week, same time at 7 p.m. Eastern time in the United States. We will be doing Cash is Clear live. I'd love to hear from you. Join the conversation by commenting, or share your thoughts, or ask a question. Whatever platform you're on, I'll get the question, I will answer it. And your wins or your challenges are important. There's a community, and we're here to support you. If you want even more help closing the clarity gap, check out the blog at cashesclear.com. Finally, I've created a guide called Boost the Bottom Line, 24 powerful cash flow strategies you control. And I've taught over 200 additional strategies in the full Cash is Clear advisory program. But you can get these tools, the 24, by going to CIC60.com. I know there's been a lot of websites. Go look for me. You'll find lots of great stuff. And until next time, be the confident cash flow advisor your clients need.